Welcome to the deep dive. We're here to cut through the complexity and give you the clearest insights from the materials you share with us. Today, we're diving into Amarin Corporation. They're a pharmaceutical company at, well, a really pivotal moment, facing some major shifts. Our mission here is to help you get a really solid, informed understanding of what's going on with them right now.
Okay, so at its core, Amarin's whole story really revolves around one key product. You've got Vascepa in the US and then Vazkepa over in Europe. And the challenge, the real tightrope they're walking, is dealing with intense generic competition here in the States, while at the same time trying to unlock value in Europe, which hasn't been easy.
Exactly. And what makes Amarin so interesting right now is that you're seeing this play out in real time. It's all about strategic pivots, these really high-stakes legal fights, and just this determined effort by the company to find a profitable path forward against some pretty strong headwinds. The materials you've sent over give us a fascinating, almost, behind-the-scenes look at the decisions they're making right now. Okay, let's start with Europe then. That seems to be where they're placing a big bet. The materials suggest they tried going it alone initially, and that didn't quite work out.
That's right. They initially tried to build out their own commercial operations across Europe, but, what became clear is that approach was just incredibly capital intensive. Frankly, it was burning through cash and wasn't sustainable in the long run. It just wasn't working.
So what did they do instead? How did they pivot?
Well, they made a pretty decisive move. They signed an exclusive long-term licensing and supply deal with Recordati. Recordati is based in Milan, an Italian pharma company. But they have a really significant footprint across Europe. This deal, it was signed June 20th, 2025. It gives Recordati the exclusive rights to sell Vazkepa in 59 countries, mostly Europe. It's a 15-year initial term, it's renewable, and crucially, it's backed by Amarin's European patents, which stretch out to 2039.
15 years, wow, that's a long-term commitment. Okay, but here's the key question for you, our listener. What's the financial upside for AMRN in this?
Right, it's structured in a couple of ways. There's immediate cash, and then there's future potential. They got a $25 million upfront payment. Yeah, one time. But let's say the bigger potential prize is in milestone payments, up to $150 million, tied to Recordati hitting certain annual sales levels for Vazkepa.
Okay, $150 million potential, but tied to sales levels, what kind of levels are we talking about? Do we know when those might kick in?
We do. The milestones start triggering once the annual net revenues for Vazkepa in those European territories cross €100. Now, Recordati themselves, they're forecasting maybe getting over 40 million in sales in 2027. So you can see hitting that 100 million mark, it's definitely backloaded. You're probably not looking at those milestones starting before 2028, maybe even 2029. Getting the full $150 million, that's going to be spread out over most of that 15-year deal. It's a long game.
A long game, definitely. Okay, so beyond the upfront cash and those future milestones, how does Amarin make money day-to-day from this partnership? Yeah, that's the other key piece. Amarin becomes the exclusive supplier of Vazkepa to Recordati. Think of it like this. They have a transfer pricing agreement. Amarin sells the finished product for Recordati at a pre-agreed price, and that price is significantly higher than Amarin's cost to actually make the drug. So that margin, that difference, is effectively Amarin's ongoing revenue stream. It's like their royalty, but it's tied directly to the volume Recordati sells.
Okay. So they get a cut of every pill sold, essentially, through the supply price. This sounds like a total rethink of their European operations. What does it do for their overall financial health, their burn rate?
Oh, it's a dramatic change. It significantly cuts down their operating expenses and their cash burn. They're projecting about $70 million in annual cost savings just by dismantling that direct European sales structure. So you're swapping out a high-risk, high-burn model for something much more stable and predictable on the revenue side and much lower cost.
$70 million a year in savings is huge, but surely there were costs involved in shutting down their old setup, right? Layoffs, things like that.
Yes, absolutely. There are upfront costs. Amarin expects restructuring charges somewhere between $30 million and $37 million. Most of that is cash, mainly for things like employee termination benefits, severance pay.
Okay, so that first year.
Right. In the first year, that $25 million upfront payment gets basically canceled out, or more than canceled out, by those charges. You're looking at a net cash outflow of maybe $5 to $12 million from this deal initially. But the real strategic value, you have to look past year one. It's that recurring $70 million annual saving kicking in from year two onwards. That's the big boost.
And Amarin isn't just washing its hands of Europe, right? They still have a role beyond just being the supplier?
Correct. They're shifting to a dual role. Supplier, yes, but also, and this is important, a scientific and clinical support role. Their remaining team in Europe is focused on generating evidence, supporting Recordati with the science. A really key project here is something called the Golden Trial. It's happening in the Netherlands, actually a collaboration with Novartis. They're looking at using Vazkepa in a sort of first-time right approach for patients after an acute coronary syndrome event. If that data is positive, it could really position Vazkepa as a foundational treatment.
Interesting, that Novartis collaboration. And what about Recordati themselves? What makes them equipped to succeed where Amarin struggled, especially in those complex European markets?
Well, Recordati has deep roots in the European cardiovascular space. They know the landscape, and their whole philosophy is what they call local brilliance. That means they tailor their approach country by country. They understand the specific regulators, the payers, the reimbursement systems in each market. Europe isn't one market, right? It's a patchwork. And that's exactly where Amarin, trying a more centralized approach, seemed to run into trouble. Recordati gets that local nuance.
Yeah, the materials mentioned Germany and France were particularly tough nuts for Amarin to crack. How might Recordati tackle those?
They'll leverage their existing local teams, their established relationships with the key players, the HTA bodies, the payers. Plus, they have a stronger story to tell now. They have more mature data for Vazkepa, real-world evidence is accumulating, and they have those important guideline endorsements from the EAS and ESC. That makes for a much more compelling value proposition than Amarin had initially.
So as this partnership gets going, what are the early signs we should watch for? What's a key indicator of whether Recordati's approach is working?
I think the launch in Italy is going to be critical to watch. It's Recordati's home turf, it's a major European economy, and Amarin just recently secured national reimbursement there, which is a big step. Success in Italy would be a really strong early signal about Recordati's ability to execute. But keep expectations in check. Remember Recordati's own forecast, over 40 million by 2027, and that 100 million milestone trigger. It points towards a gradual build, not an overnight success story. Patience is needed here.
Okay, so Europe is about a strategic pivot, a long game with Recordati. Meanwhile, back in the U.S., the fight continues for their core market. And our materials suggest something potentially big might be happening there. News about Aetna's coverage policy through CVS Caremark.
Yes, this is potentially very significant. According to the information we have, CVS Caremark is reportedly giving branded Vascepa exclusive status on its commercial formularies starting July 1st, 2025. That would mean rejecting the generic versions for those specific plans. Now, it's really important to stress, this specific change, while potentially huge, isn't independently verified across all the research materials provided, so we need that grain of salt.
Understood. But if it's confirmed, what kind of financial impact could this have for Amarin? This sounds like it could be a major boost.
Oh, it would be substantial. If confirmed for those commercial plans, it could really start to reverse that severe price and volume erosion they've seen since generics hit the market, at least within that large block of patients covered by CVS Caremark. It would almost certainly force Amarin to positively revise their U.S. revenue guidance for the second half of 2025 and going forward. It could be a real lifeline for their main revenue source.
So the listener asks, if this news is potentially so good, why has Amarin management been so quiet about it? What's the thinking there?
There are likely a few strategic reasons playing out. First, confidentiality. These kinds of agreements with PBMs like CVS Caremark often come with strict confidentiality clauses. The PBM might control the timing of any announcement. Second, they do have that authorized $50 million share buyback program. Announcing major positive news would likely drive the stock price up, making those buybacks more costly if and when they decide to execute them. Though, as you pointed out, they haven't started buying back shares yet.
Right. And the third reason, perhaps the most critical one, ties into that big legal fight, doesn't it?
Exactly. The absolute most critical strategic reason for silence is likely the ongoing high-stakes litigation against Hikma Pharmaceuticals over patent infringement, which has gone all the way to the Supreme Court. Publicly celebrating a big commercial win like preferred status with CVS could potentially undermine Amarin's legal arguments. Hikma could argue, see, they can compete effectively in the market. They aren't being irreparably harmed by generics. It's a calculated silence to protect their legal position.
That makes sense, a strategic calculation. So if this CVS deal pans out and is successful, what's the chance other big PBMs like Express Scripts or OptumRx might do something similar?
It really all comes down to the net cost. PBMs are driven by getting the lowest possible price for their clients. If Amarin has offered CVS a rebate that makes the net cost of branded Vascepa lower than the net cost of the generics, well then competitors like Express Scripts and OptumRx would be under immense pressure from their clients to get a similar deal. It could potentially open the door for Amarin to win back significant share across the board, but likely at a lower net price overall than pre-generics.
Okay, let's talk more about that Supreme Court case. Hikma Pharmaceuticals versus Amarin Pharma. You mentioned it's a big deal, potentially for the whole industry. What's the core legal question?
Right. The heart of the case is this issue of induced infringement and something called a skinny label. So a skinny label is when a generic company launches its drug but deliberately leads off the patented use from its FDA-approved label. Hikma did this with their generic icosapent ethyl, carving out Amarin's patented use for reducing cardiovascular risk. But Amarin argues that even with the skinny label, Hikma effectively induced doctors to prescribe the generic for that patented use through their marketing, public statements, maybe even pricing strategies, essentially saying you knew what doctors would do. The Supreme Court asking for the Solicitor General's view definitely signals they see this as having broad implications beyond just these two companies.
And the potential outcomes sound really stark, very black and white for Amarin's U.S. business.
It's extremely binary, yes. If the Supreme Court denies cert, decides not to hear the case, the fight goes back to the lower district court. That's generally seen as a win for Amarin, keeping their legal options open. If the court hears the case and rules for Hikma, it could basically shield generics using skinny labels from inducement claims. That would significantly damage the value of Amarin's U.S. business. But if the court rules in favor of Amarin, it's a landmark win for brand pharma. It would make it much tougher for generics to benefit from patented uses they've technically carved out and could lead to a big damages award or settlement for Amarin. So massive uncertainty hangs on this.
Wow. Okay, so while that legal cloud hangs overhead, Amarin isn't just waiting. The materials mentioned they're actively trying to rebuild their intellectual property, their moat, so to speak. How are they doing that?
Yeah, this is a pretty clever and, importantly, capital-efficient strategy. They're filing new method of use patents, specifically in the U.S. An example given is a patent application for using Vascepa for methods of reducing a need for peripheral arterial revascularization, or PAR, in patients already on statins. And they're doing this largely by mining existing data, looking at real-world evidence databases, maybe digging deeper into the REDUCE-IT trial data rather than launching costly new clinical trials. It's like IP generation on a shoestring budget.
Smart. So what are the goals with this new IP strategy? Is it just about extending patent life?
It's more nuanced than just extending life. It's multi-pronged. First, yes, creating new, distinct patents forces generics to carve out even more uses, making their labels skinnier and potentially less appealing or useful to doctors. Second, even before a patent is granted or a new indication approved, they can use this emerging data to educate doctors, potentially influencing prescribing habits. Third, sometimes new patents can trigger regulatory stays, buying them more time, and importantly, it makes Amarin look better as an M&A target. Building this picket fence of new patents around their core asset makes the company potentially more valuable and cleaner for an acquirer.
Okay, let's zoom out a bit and look at the overall corporate health. The materials paint a picture of, well, declining revenues and a history of losses. How are they managing financially?
That's the challenge, absolutely. Q1 2025 revenue was $42 million, down 26% year over year, mostly due to that U.S. generic pressure. And yes, they've had, I think it's over 20 straight quarters of operating losses. So the whole strategy we've been discussing, stabilize the U.S., get that low-cost European revenue via Recordati, and look for longer-term growth in places like China, it's all designed to eventually get them back towards profitability or at least cash flow breaking.
What about their cash reserves? How much runway do they actually have?
As of the end of March 2025, they had about $281.8 million in cash and investments, and importantly, no debt. Their cash burn in that first quarter was $12.4 million. So that gives them a cushion, definitely a multi-year runway at that burn rate, but managing that cash burn is obviously a top priority. Those cost savings, we talked about the $70 million from Europe, plus earlier U.S. savings are crucial for extending that runway.
Now, the materials also touched on some shareholder friction, some activist pressure on the board. What's been happening there?
Right. There was a significant development in April 2025 when Michael Torok from JEC Capital Partners joined the board. That was widely seen as a direct response to activist shareholder pressure demanding better capital allocation and strategy. His appointment, likely played a role in pushing forward that Recordati deal, which directly addressed the cash burn issue shareholders were concerned about. You also saw shareholder frustration at the annual general meeting in May 2025. They actually voted down a proposal that would have allowed the company to issue new shares without offering them to existing shareholders, first basically rejecting potential dilution without their say-so. That forced the board to switch to paying non-employee directors in cash instead of shares. It shows shareholders are watching closely.
And that shareholder focus brings us back to the share buyback program. You mentioned the $50 million authorized program, but they haven't used it.
Correct. It was approved way back in January 2024, but as of the latest updates, AMRN hasn't bought back any shares. Their official line is they continue to monitor business and market conditions. This is definitely a point of friction. Many investors look at the cash balance, the lack of debt, the beaten-down stock price, and think, why aren't you buying back shares aggressively? It really suggests the board is prioritizing conserving cash for that long operational runway above all else, even potential short-term support for the stock price.
Okay, looking further out then, 5, 10 years, is Amarin planning to diversify? To find something beyond Vascepa or Vazkepa?
Publicly, no. Their stated strategy, their whole focus, is on maximizing the global value of this one asset. A big piece of that long-term picture is China. They got regulatory approval there for the cardiovascular risk reduction indication, which triggered a nice $15 million milestone payment. But the really critical step in China is getting Vazkepa included on the National Reimbursement Drug List, the NRDL. That's what unlocks widespread access and volume. They're targeting NRDL inclusion for 2026. That's a key catalyst to watch.
And putting all these pieces together, the European de-risking, the IP building, the focus on cash, does this make Amarin a more likely takeover target?
While they haven't put a for sale sign up, you could certainly argue their actions are very consistent with making themselves more attractive as an acquisition target. Think about it. You clean up the European P&L with the Recordati deal. You try to stabilize the U.S. market, maybe win the Hikma case. You build some new IP defenses. What you end up with is potentially a much cleaner asset, a single globally marketed product with more stable financials, maybe stronger IP, and clearer legal footing. That's a much easier pill for a larger pharma company to swallow as a bolt-on acquisition.
It really does seem like everything hinges on this one asset. Given that intense focus, what does their R&D actually look like? Are they even doing much traditional research?
Their R&D is really about life cycle management, not discovering new molecules. The budget reflects that. It was only $5.3 million in Q1 2025, which is pretty modest for a pharma company. The main goal is to find ways to expand Vascepa's use into new areas, ideally ones they can patent, often, as we said, by digging into existing data.
Can you give some examples of these potential new uses they're exploring?
Well, besides that PAR indication, peripheral arterial revascularization we discussed, they're looking at combining Vascepa with those popular GLP-1 drugs like Wegovy and Ozempic. There's some early science suggesting Vascepa might help address the residual cardiovascular risk that remains even in patients doing well on GLP-1s. It's potentially a huge market. There's also mention of a pending patent for a new formulation, something about lymph-releasing EPA, but the materials didn't have much detail on how far along that is.
And underpinning all of this, all these new ideas and patents, is still the original REDUCE-IT trial, right?
Absolutely. REDUCE-IT is the bedrock. It's the landmark study that proved Vascepa's benefit in the first place.
Yeah.
Even years later, AMRN is still funding and publishing analyses based on that trial data, like a recent one in the Journal of the American Heart Association, showing the benefit held up regardless of patients' starting LDL cholesterol levels. This constant stream of publications serves multiple purposes. It keeps Vascepa scientifically relevant, it gives partners like Recordati data to use, and it helps influence clinical practice guidelines, which ultimately drives prescriptions.
Okay, so let's wrap this up. What's the key takeaway for you, our listener, from this deep dive into Amarin? It's clear they're at a critical point. They've made some bold, arguably necessary moves like the Recordati partnership to try and stabilize the ship and de-risk Europe. But in the U.S., it's still very much a battle on multiple fronts: generics, payers, and the courts.
Exactly. The success of this turnaround really hinges on a few things going right. The risks are clear. Continued pressure from generics in the U.S., huge uncertainty around that Hikma Supreme Court case, and just the basic execution risk of whether Recordati can actually deliver on the promise in Europe, plus that fundamental vulnerability of relying entirely on a single product.
But on the flip side, there are real opportunities too. Europe now has a clear, lower-cost path forward. There's potential maybe for stabilization in the U.S., depending on CVS and the courts, and they are looking increasingly like a plausible M&A candidate down the line.
Yeah, so if you're tracking Amarin, the key things to watch are pretty clear. Keep an eye on those U.S. Vascepa sales and prescription trends. Are they stabilizing? Watch the European sales ramp under Recordati. Is it meeting expectations? monitor their quarterly cash burn or the savings materializing, and absolutely keep a close eye on any news out of the Supreme Court regarding the Hikma case. Those are the real needle movers.
AMRN has definitely bought itself some time and created options, but now it all comes down to execution. The board seems to have made some tough, but arguably rational decisions. How it all plays out will be fascinating. We really hope this deep dive has given you a much clearer picture of AMRN's strategic landscape and the key things to watch as their story continues to unfold. If you found this valuable, please do consider subscribing to the show, maybe give us a like, and definitely turn on notifications so you don't miss our next deep dive into a topic that matters to you. We'll be back soon with more insights, always aiming to help you become truly well-informed.